Hello, everyone, and welcome to a new meeting of the Finance Network series titled In Conversation, exploring the philosophy of money and finance. And today we are very delighted to welcome teacher Endörfer from University of Victoria, who will be interviewed by Kobe Feinstein from University of San Diego. So thank you very much, Richard and Kobe, for accepting our invitation. And today's interview is titled On the Wrongfulness of Bank Contributions to Financial Crisis, and is inspired by a chapter authored by them in the volume, by Richard, in the volume The Philosophy of Money and Finance, edited by Jürgen Sandberg and Lisa Warensky, and published by Oxford University Press. Today's interview will revolve around a stimulating issue. What exactly makes banks morally responsible when their action help triggering financial crisis? As usual, following the interview, we will open the floor for discussion. If you'd like to ask a question, please raise your virtual hand using the Zoom menu, and I will moderate the queue. And that's all from me for now. And let's begin the interview and enjoy it.
Well, I'd first like to thank Lisa and Emiliano for inviting me for this, and Richard for the excellent chapter and for what I hope will be a really interesting conversation. So, Richard, I wanted to start off by asking more for people perhaps who haven't read the chapter. Can you explain what you take to be the primary wrong that banks commit in the lead up to a financial crisis? And also how you see this as differing from normal banking operations.
Yeah, I can. First of all, allow me to also thank Lisa and Emiliano for having me, and to thank you for running this interview. It's very much appreciated. This is a great opportunity to share some of my work. I really like it. Really looking forward to it. And also, if you happen to have read this chapter and you enjoyed it, I can highly recommend to you to pick up the book, because it contains chapters that are, I'd say, in my own view, even much better than what I have delivered here. So there's a lot to enjoy in that book. All right, back to your question. So what's the primary wrong that banks commit in the run-up to a financial crisis? I think it's most easily subsumed under the idea that in the run-up to a crisis, they lend money to counterparties that are not creditworthy. And when we're at the height of the crisis, when a credit crunch occurs, they do not lend to parties that are creditworthy. So it's kind of a mismatch in time, right? That's kind of the idea here, right? It's not the right people that that loans are extended to in the beginning, and it's too few of the creditworthy people that loans will be extended to once the crisis actually hits and we see a credit crunch, right? So basically the idea is built, it's not my own idea, but it's essentially built on the ideas of Hyman Minsky's financial instability hypothesis. So let me summarize that hypothesis really quickly. The idea is we start out right after a financial crisis. That is kind of the first step. After a financial crisis, we see a situation in which there's so much worry about lending to the right people that banks find a very, very small number of suitable counterparties, essentially. And these counterparties are actually really safe borrowers. Like, they will be able to pay back these loans without any problems. And so as this goes on and everything feels safe, banks start to try to increase their profits by lending out to more risky parties. And this goes on and on and on, and we're now in the boom phase of a financial crisis. And then at some point, we will reach what Hyman Minsky calls this upper turning point, where the costs of producing goods are essentially, the profits that would come out of producing goods are essentially eaten up by the financial costs that are involved in producing these goods. because the demand for credit increases, therefore the price for credit increases, the interest rates, that is. And so at some point, the counterparties that actually take on these loans won't be able to pay them back out of their day-to-day operations. So that's basically the idea. And once that happens, the issue is that there will be some kind of minor event where some counterparties can't really pay back their loans. There's a worry spreading among the lenders that they can't identify the creditworthy counterparties anymore, and so they essentially stop lending to pretty much everyone. And that kind of event is known as a credit crunch. And that's what we usually call the financial crisis. It's a state of affairs in which the financial system no longer operates as it's supposed to. It's not lending, it's not giving out, it's not ensuring that credit is given out to the creditworthy. And therefore, essentially, we have a collapse not only in the financial sector, but also in the real sector, where a lot of companies actually depend on having these loans in order to continue their day-to-day operations. And that triggers like a domino effect in the real economy. That's basically the idea. And once we reach that stage of a credit crunch, the cycle begins again, right? Safe lending, then more enthusiastic lending, too much risk. Then at some point this entire thing collapses again, and then the cycle starts over. So it's essentially a theory about business cycles, macroeconomic theory about why financial crises are endogenous in our capitalist system. So what exactly then is the wrong, as I've said, right? It's essentially like giving out too many loans at a time when these banks shouldn't give out the loans, and not giving out loans at a time when they should be giving out loans. It's kind of like a time mismatch, right? And these two types of actions actually contribute to the risk of some systemic event happening and to the size of the systemic event. That's kind of the idea that I'm operating with here. So the second part of your question was how does this differ from normal banking operations? And I'm not really sure whether it differs from normal banking operations, right? So the lens of the financial instability hypothesis essentially tells us like this is what banks will do if you give them the room to do these things. They will maximize profits. That's what they do. They're profit maximizing firms in a capitalist system. What do you expect? So really the question is not so much about whether these are normal banking operations or not. Rather the question is, within what kind of institutional framework do these types of transactions take place, right? So as I'm thinking about these things now, it's much more in terms of institutions, right? Institutions and incentives. So again, I don't think that these kinds of operations deviate from kind of normal standard, except for the standard that would be set in an ideal, perfectly competitive market, right? So if you take that to be the normal standard, then yes, they deviate. But if you think that banks are just profit maximizing firms in a non-ideal market, then I don't know if they deviate from any normal banking operations if they do these kinds of things. This is what is to be expected.
Well, thank you for the answer. And that actually draws me into my next question that I had. So I was curious, what drew you to this topic, specifically financial crises, but also a focus on the banks and the wrongness of bank operations, rather than, say, consumers for requesting loans they can't fulfill, or regulators that allow for these kinds of intertemporal mismatch that you're describing. So why financial crises and why a focus on the banks in particular?
Yeah, all right. So with regard to the focus on financial crises, well, I mean, I'm a child of my times, so the financial crisis happened when I was in my late teens, and it kind of led to like a political awakening, personally speaking. I remember my dad was really worried about losing his job at the time. I mean, this crisis began in the USA, but it spread all over the world, and I grew up in Germany, and so all of these like mid-level automotive suppliers and industrial suppliers, they also faced the fallout from this, and my dad was one of the people who could have easily been affected. Fortunately, he wasn't. But I mean, yeah, so quite simply put, it's probably one of the most important events that occurred in this century so far. It has shaped the political landscape all over the world for, well, probably up until now, right? I mean, if you read Adam Tooze's Crash, the main thesis there is that it's the financial crisis that brought us the first Trump presidency, right? And the financial crisis is often pointed to by political scientists as like one of the origin points of kind of like the awakening of far-right extremism that we see in our liberal democracies today. So I think it's a tremendously important event. I have personal connections to it. But apart from that, it's also really interesting from a professional perspective for a philosopher, right? So it leads you to all of these like fun little puzzles because it has so many features that are really interesting and that are connected to like debates that are currently going on in philosophy. So I mean, one of the obvious issues that you have to answer if you're looking into financial crisis is how should we think about risk impositions, right? What kinds of risks are acceptable, what kinds of risks aren't. The other part of it is obviously how should we think about harms or risks that are produced by a collective, right? This is another wrinkle that's kind of complicated to answer if you only have like the standard repertoire of normative ethics at your disposal. And to me, what that led to in my current research is mostly that I got more interested in the political question that kind of overarches this entire thing, which is, should we really think about markets as these kinds of moral free zones, right? And if so, if they are moral free zones, under what conditions are they moral free zones? So I think like thinking about financial crisis really brings all of these fun puzzles with it. It makes for an immensely interesting subject. It is politically extremely relevant for understanding what we're facing today, and what kind of risks we probably should try to avoid in the future. Yeah, and with regard to why I haven't focused on other institutions than banks, really. Why haven't I looked at regulators or consumers in this particular piece? So in my thesis, I actually look at consumers and consumers' responsibility for financial crises. I find that interesting, but I think like the most salient causal contributor to financial crises, and that's kind of like a generally accepted view, are banks ultimately, right? Like they seem to be like the active ingredient in this entire causal story that brings about financial crises. So that's why I thought, well, if you're saying something about financial crisis, you should probably say something about banks. Obviously, I could have picked out other parties because they also have a massive causal impact. But for this particular piece, I figured I should focus on banks because it's intended as an introductory piece into normative ethical thinking about financial crises. So if you're interested in regulators, then I can highly recommend Boude van der Bruyn's book on the global financial crisis, which is an excellent piece. It also talks about credit rating agencies and how important they are, and it has a much more rich virtue ethical story to tell than I actually than I provide here in this very short piece, right? So if you're interested in these topics, there are other people who have written prolifically on these issues and probably in much more interesting ways than I could ever be able to. So I'll gladly point you to them.
Well, thank you for that answer and for kind of deepening the connection. I'm also a child of the financial crisis, so it resonates on a personal level for me as well. What was I going to say? So you mentioned in your last answer, and it's a central part of the paper, this idea of a collective harm. So I was wondering if you could say a little bit more about how that term is used in kind of the political philosophy realm, and also why you perceive financial crises as collective harms.
Yeah. So collective harm problems are kind of like really interesting cases for normative ethicists because they have a couple of really special features, I think. So in this particular piece, I point out three features. The first feature is collective harms are harms. Second feature is they're brought about collectively. So let me add duh. And the third feature is that, at least at first glance, and this is what makes them so interesting from a theoretical perspective, at least at first glance, individual causal contributions to these kinds of collective harms seem to be negligible, morally as well as causally. And so that turns them into interesting little puzzles. So there's a large, fairly established literature on these types of collective action problems in climate ethics. There's a large literature established on the more general problem of what collective harms are. And here in this particular piece, I apply these insights to the best of my abilities to the case of financial crises. So the example, the more general example that I use here in order to illustrate what a collective harm is Parfit's harmless torturers. So the harmless torturer case is about a person strapped to some kind of device, and connected to that device are, let's make it 10,000 buttons, right? Each button has a person assigned to it. If the person presses the button, a small amount of electrical current goes to the device that this victim is strapped into. So when one particular torturer presses the button, nothing really happens, but at some point we will reach some kind of threshold at which the electrical current becomes so strong that the victim is in immense pain, right? And so here you can see the kind of three features, right? So it's a harm, somebody's in immense pain, it's brought about collectively because you need a sufficient number to reach the kind of threshold of button presses. And thirdly, this case is set up so that none of the individual button presses actually inflicts any perceptible amount of pain on the victim. So these are kind of like the three features. And I think that it's useful to think about financial crises in this particular way because they're structurally similar in interesting ways, right? So I'm thinking mostly about systemic financial risk as the kind of harm that we should be considering in these cases. And systemic financial risk obviously will fit the first of these features, which is it's a risk of harm, right? Secondly, it's usually brought about collectively. It's a lot of transactions that are going on in the market that generate this kind of risk. And thirdly, at least at first glance, it looks as if none of the individual parties that participated in these kinds of transactions actually on their own significantly increased the risk of a financial crisis happening. So the systemic financial risk. And so I think it fits exactly these three features. Now, obviously, it's not exactly it's not a perfect match to the harmless torturers case because different financial institutions will contribute to a different degree, causally speaking, right? Like their causal impact will differ. They will operate under different business models, so their reasons for participating in the collective harm will differ. I mean, obviously they're all chasing profit, but beyond that, the ways in which they chase profit might be philosophically interesting in order to assess whether they are doing something wrongful or not, because the reasons for their action will differ. Yeah, so I think like it's not a perfect match, but like the structurally interesting features are there, and therefore I think it's really useful to think about these cases in terms of collective harms.
Wonderful, thank you. And so within the paper and also from this discussion, this idea of the collective harm seems to motivate the pro tanto wrongness of these sorts of lending operations.
Yes.
You're very careful throughout the paper to say that this is just pro tanto, it's not a full-scale moral accounting. I'm curious if you could say a little bit more about kind of countervailing reasons that you might think are relevant, that might go against the kind of wrongness of these sorts of bank operations.
Yes, absolutely. So first of all, let me just acknowledge that usually when philosophers are engaging in applied debates, they usually only consider pro tanto reasons, right? Like doing the whole pro toto thing seems to be like a lot of work, and apparently we're very lazy people. There are some people who disagree with this, quite interestingly, and who think that we should embrace a pro toto approach, but that's at least not what I'm doing here in this paper. So, what precisely might be the countervailing reasons that render these pro tanto wrongs potentially pro toto permissible? Well, I think there are two classes of reasons that I would like to bring up here. The first one has to do with moral responsibility, right? In order to be able to conduct a wrong, you have to be the right kind of agent. You have to be a moral agent to a certain degree, right? So the first question, since I'm looking at banks, is obviously whether banks could even in principle be the right kinds of moral agents to conduct wrongs. So if that's not the case, then that's a countervailing reason, right? Like there can't be any wrong conducted by the wrong kind of agent. But there are also other reasons that we might want to consider. So even if they are the right kind of agent, we usually think of moral responsibility in terms of the three standard Aristotelian conditions, right? The epistemic condition, the control condition, and the causal condition. So in this particular piece, I'm not really touching the causal condition. I'm just assuming that this is correct, that banks actually have a causal impact on financial crises. But there are still two more conditions left, right? The control and the epistemic condition. So with regard to the epistemic condition, we might think that banks aren't really doing anything wrong if they don't know how and whether they are contributing to systemic financial risk, right? So that might be a countervailing reason to thinking that they are not actually, they're doing wrong. So even if the causal condition is fulfilled, these banks might simply not know how much they're contributing and whether they're contributing at all. And knowing about these things, I mean, there's kind of like a division of social labor here. And knowing about the amount of systemic financial risk that is in the system is typically placed with regulators. So in Europe, the ECB is tasked with knowing about the amount of systemic risk in the system. In the US, as far as I'm aware, it should be the Financial Stability Oversight Board that has been established after the crisis. And there's an international organization that's called the Financial Stability Board that also has kind of like the same mandate of like watching over how much systemic risk is in the system. However, do I buy that as a countervailing reason on balance? Perhaps, yes, but there's good reason to believe that banks in the system, as it is as of now, have incentives to underplay their causal impact on systemic risks, and they might therefore, like, I think it's a plausible assumption to think that in many cases they will have better information than the regulators themselves about what they're actually doing, even if they might not have perfect information about like how much they're contributing to systemic risk. I mean, as far as I'm aware, they're required to measure it in some ways in their models, but the main kind of charge of keeping watch over this is still with regulators. Still, again, insofar as there are information asymmetries here, and there might very well be, I'm not sure whether they can escape the epistemic condition so easily, but that's just a gut feeling of mine. Actually saying something more substantial would require a lot of epistemic work, a lot of empirical work that I'm not doing in this particular piece. With regard to the control condition, I mean, banks are usually public corporations. So they have a mandate to actually generate profits for their shareholders. So how much can they avoid contributing too much or lending out to individuals that are not creditworthy given particular market pressures? I'm not so sure. That I think, again, like to bring back the institutional point, this kind of depends on institutional background conditions overall, right? So how far we allow banks to actually have control over how much they contribute to systemic financial risk really depends on what kind of institutional pressures they face, what kind of institutional background of what kind of institutional structures we have in our financial system. So these are the interesting questions if you want to assess the control condition. I'm again not doing this in this piece, so that's why I'm limiting myself to saying that there's only pro tanto reasons. You would need a much deeper empirical investigation in order to assess these things, I think. So
Thank
that's
you.
the
And I
first
mean,
part. That's the first part. I can elaborate further because there's a second part, right? The countervailing reasons might also be related to consequences, right? You might think that in some cases it's actually worth running the risk of a financial crisis because you will have such a massive expansion in economic growth because of expanded lending. I mean, again, that's subject to empirical analysis. There's a great report by the Roosevelt Institute called the High Cost of High Finance. They're trying to estimate the costs of running this particular institutional financial setup. Um, Again, subject to empirical considerations that I'm simply not doing in this particular piece. Yeah.
no, thank you. And I agree. Philosophers usually stick to the pro tanto. I was just curious what reasons you might think would be relevant in this.
I'm lazy to make
You
a very
talked a
long
lot about
answer
the
short.
you talked a lot about the epistemic condition. And so
Yeah.
that drew me to one of the discussions in the paper I thought was very interesting was the way you treated virtue ethics, that you claim fails to be able to account for the wrongness of bank contributions. I was wondering if you could say a little bit more about what role, if any, you think virtue ethics can play in our understanding of financial crisis, specifically the epistemic virtues, which you briefly mentioned in the paper, but given your previous discussion about the kind of epistemic condition might be relevant.
Yeah. So what I'm trying to say in this paper is something very limited, actually. I'm not trying to say that virtue ethical theory is just unsuited for investigating financial crisis related phenomena. Grosso modo, that would be a ridiculous claim to make, I think. But I think it's a less elegant theory than other competitors when it comes to assessing the wrongfulness of bank contributions in particular, right? So the one point that I really wanted to draw out is that I think there's a lot of intuitive pull to the claim that I'm making on page 222 when I close down the piece, which just says any moral theory aiming at evaluating bank contributions to systemic financial risk should at least in principle be capable of acknowledging that we have a pro tanto reason to consider bank contributions to financial crises as morally wrong. And I think virtue ethics has a really hard time pulling that off, to be honest with you. So I'm trying to illustrate that via two examples in the piece, the land loan 1 and land loan 2 examples. Essentially, what's happening in these examples is that there's an extension of a loan to a credit unworthy party. And in the first variation of the case, all of the bankers involved in extending that loan are perfectly virtuous. These are extremely virtuous people. They know exactly what they're doing. They're great at their job. They have gone through all of the ethical training that you could wish for a banker, and still they extend the loan. And then there's a second variation of this case in which you are dealing with vicious, extremely greedy, and completely incompetent bankers. And they're so incompetent that they don't really see the profit opportunity from extending that particular loan. And so they don't extend it, right? So in the first case, you have a causal contribution, even though everyone is perfectly virtuous. In the second case, you don't have a causal contribution, even though people are vicious or incompetent. And so I think that poses a problem to virtue ethics. I think because of this particular problem, virtue ethical theorists are very likely to underestimate the number of cases in which there's something wrongful going on, but there's nobody vicious involved. So they are likely to underestimate the number of cases in which there are actually wrongful contributions to a financial crisis. And so that's why I kind of try to say, well, it's a great approach for investigating many phenomena, but probably not this particular one of wrongful contributions. So what do I think is virtue ethics good for? I think it can do two things really, really well. So first, it can provide a particularly interesting explanation for how a financial crisis comes about. So if you look at Baudevine, De Bruyne's book on the global financial crisis, it's a masterpiece on showing you exactly what these explanations should look like. And I think it's really informative and it's really interesting. So he kind of shows that at least some of the institutional players that were involved in bringing about the financial crisis were vicious. They did not exhibit the right kinds of virtues, and therefore they engaged in actions that then ultimately led to a financial crisis. The second kind of thing that I think virtue ethical theories are really good for is they might actually tell us something about how we ought to train future financial professionals, right? What kind of virtues they should exhibit in order to make sure that kind of on the micro level, at least, we do not set the wrong incentives that might lead to a financial crisis down the road. So I think these two tasks in particular, virtue ethical theory, is really, really useful for. But when it comes to assessing the wrongfulness of bank contributions, there might be better candidates out on the market.
Wonderful, thank you. And so that brings me to your preferred solution to identifying the wrongness, this ex post contractualism. I was wondering if you could walk us through that account and why you think that is the best way to kind of make sense of the wrongness of bank contributions, especially in contrast to kind of the ex ante contractualism.
All right, I can try. If you thought my earlier answers were too long, this one's going to be a doozy. So contractualist theories essentially operate on the assumption that the permissible actions would be permitted under a suitably specified social contract, right? So the framework that I'm operating in is Scanlonian contractualism. And Scanlonian contractualism essentially does not evaluate actions at all. It evaluates principles that would license actions. There are two constraints that are relevant for the case that we are considering here, which is financial crises. The first constraint is the so-called individualist restriction, which would state that only so-called personal reasons for rejecting a particular principle that would license some conduct are valid. Personal reasons are essentially reasons that affect the agent themselves, right, and nobody else. They do not have anything to do with the shape of the distribution of benefits and burdens. They just have something to do with the general reasons that an agent in this particular situation might have for or against licensing a particular type of conduct. The second principle is the greater burden principle, which essentially tells us how we ought to think about which kinds of principles we ought to reject and ultimately how we ought to rank the different principles. The greater burden principle essentially says that if you have a burden imposed on you, it would be unreasonable to reject the principle that imposes the burden on you if all other alternatives would impose greater burdens on others, right? So there will always be a balancing act involved in this. So the idea is always what we track is the burden to the worst off. And the worst off kind of like sets the tone for which principles will be acceptable or not. Now, I should say that, at least in my view, contractualism is still kind of a view that's in its infancy. It's really useful. It combines like interesting elements of consequentialist thinking with deontological thinking, but there are still some major issues that contractualists have to work out here. One of them is the issue of uncertainty, right? So that brings us to ex post and ex ante contractualism. So these are kind of like the main contenders in the realm of risk applications of this theory. They differ in particular with regard to how they think about burdens. So, as I've already said, burdens are really, really important in order to assess whether a principle is acceptable or not. Ex-ante contractualists think that the right kinds of burdens that we should consider are essentially like the expected disvalues that people stand to suffer if a particular if a particular principle is adopted, right? So, if, for example, we have a principle that allows banks to hand out excessively large and excessively risky loans, then the relevant burden to the worst off would always be one that assesses what the expected disvalue from this kind of conduct is that that person might suffer. So it's always the burden discounted by its probability. The exposed contractualists don't think in this particular way. They think that the right burden to assess has nothing to do with the probability. As soon as we can be reasonably certain that at least one person will suffer that burden, they take the full amount of the burden to be the relevant, so not the one that's discounted by probability. Why am I so interested in exposed rather than ex-ante contractualism? I think there was a large wave of people rejecting exposed contractualism. That's kind of the view that Scanlon started off with originally, because they thought that exposed contractualism is really prohibitive. So the second that we know that some kind of conduct will, for example, lead to the death of one person, we would have to reject that entire conduct, right? That seems extremely prohibitive. The second we are sure that somebody has at a reasonably large, that we can expect that somebody might die, for example, from being involved in the building of some large skyscraper or something like that, we would have to prohibit building the skyscraper. And so people rejected the view and they adopted the ex-ante view because it allows them to discount burdens to a certain degree. I think that was a mistake because I think that it's a misreading of what the exposed position actually says. So in some other works I'm looking at that I've put out, I'm looking at compensation. And I think that compensation can explain to us why precisely exposed contractualism isn't as prohibitive. So the idea would then be adopted to this particular case. You can run all the financial risks that you want, as long as you ensure that the people who will actually suffer the worst burden will not be made worse off than anyone else would be under any other alternative principle, right? So if you have a well-functioning social welfare state in the background, you can run the financial risks that you want, essentially. That's the idea. It's not a prohibitive scheme at all. However, ex-ante contractualism actually has problems with compensation. So if you're interested in these kinds of thoughts and in the risk ethical nature of these two positions, then I would point you to a different piece that I wrote at some point, which is also, I think, has some interesting insights to the debate, but it wasn't particularly relevant for this applied case here.
So thank you for that. So I only had one last question for you, and it touches on this notion of risk. And I think it actually draws back to your initial characterization of financial crises and the wrongness associated. So at the beginning, you talked about creditworthiness, and you also talked about a kind of mismatch in the lending operations. So throughout the piece, you also talk about severe or excessive risk, and you characterize it as unjustifiable or irrational. So from what I've gathered from our conversation, there's some sort of background institutional conditions that might set up what counts as excessive. I'm wondering if you could say a little bit more about both what those kind of background conditions would be, or really more generally, what determines excessive risk or severe risk versus reasonable risk. And then also how this kind of relates back to kind of the identification problem. Because you say part of the problem leading up to a financial crisis is that banks cannot identify who is and who is not creditworthy. So I'm wondering both what sets the line for excessive risk and how this plays into kind of the epistemic functions of banks.
Yeah. Well, what can I say about that? I think like the cleanest way to think about like where to set the threshold between excessive and non-excessive risk actually comes from economics itself. How much systemic financial risk is excessive? The answer is pretty clear if you look at like standard microeconomic theory. Anything above zero is excessive. Anything above zero will count as an externality. It's a market failure. It's an externality precisely because people usually don't pay the full price for wrecking a system, right? So anything that leads to a non-zero amount, I think from an economic perspective would have to be considered excessive. That, however, has constraints, right? So if I'm saying anything above a zero amount, that would count for this like idealized world in which we have a perfectly competitive market, right? As soon as we deviate from that standard, we have something to justify. In many cases, we might be able to justify it because there are so-called transaction costs in the background. You can't simply eliminate systemic financial risk without running the risk that whatever you're doing might actually impose worse harms on the system overall, right? So there's always this like balancing act between which kind of policies you should embrace, and you should probably embrace those that generate the fewest externalities. That's kind of the clean-cut economic answer here, right? So given a particular financial setup, what is the excessive risk? Well, the excessive risk would be the risk that is not the minimal risk, given a particular set of transaction costs in the background. So the idea here would be that ultimately we would have to choose a particular financial setup that minimizes the amount of systemic financial risk in the system compared to the benefits that would be gathered from running a risky financial system setup. That's essentially the idea. With regard to the epistemic challenges that banks might face here, yeah, banks face their own transaction costs, right? Banks, like these are essentially information costs. So if banks extend loans to non-credit-worthy borrowers, in some cases, they will do so, and we might in some cases have to say, well, they genuinely couldn't have known better, because there are excessive costs to acquiring that information that would just be completely inefficient to actually take on. In some cases, probably in many cases, for the global financial crisis, the costs of acquiring that information weren't particularly high. I think that's exactly the kind of thing that we feel upset about when we're thinking about the financial crisis. This seems kind of like it could have been avoided with a different mentality, with a different kind of like ideological mind state, with a different kind of how should I say, willingness to accept risks in the system, right? But it seems, at least like to the layperson that I am, that many of these issues just weren't taken up, even though it would have been perfectly efficient and perfectly cost effective to actually take them up. So we operated on old models. That's an old complaint. We had credit rating agencies that had the wrong kind of incentive system. We had regulators that had ideological leanings that forbade them from actually assessing the risks in the system properly. We had banks who lobbied against secure and probably successful financial regulation. We still have them. We're just going through it again right now with everything that's going on in the United States, and even on the European level at the moment. There are fights about capital requirements. So all of these factors actually play a role here, I think.
Well, thank you so much for the answer, even if it was a slightly depressing answer at the end. That's not your fault. But I wanted to, first of all, thank you for both the opportunity to read the paper and talk about it with you, and then now open it up to everybody else if other people have questions.
Okay, thank you very much, Lisa and Kobe. So you can now open the debate. I don't know if there are questions coming from the audience. So please raise your virtual hand. Otherwise, I have a question to break the ice. Okay, so I will do my question.
Yeah.
So thank you very much, Lisa, for this interesting interview. And so my question is about the Minsky's rules of your paper.
Yeah.
And so if you're right, as I think, probably the variable that we should measure and oversize the most is private debt instead of public debt. And so I don't know if you have something to say about this and the idea that what we should measure is how banks are exposed to private debt more than public debt, while in the mainstream, I mean, economic theory and also, I mean, newspaper, the accent is on the public debt.
Yeah. Yeah. Thank you. That's a really good question. I mean, I have my own views on this, obviously, and I would not say that I'm sufficiently well trained in economics to say that they're fully determinate. But again, like I essentially my academic upbringing was accompanied by reading Minsky. So yes, I do think that private debt is the lever to look out for, precisely because, as Minsky explains, private debt is essentially the variable that explains to you how a completely stable economy can go to an unstable economy, right? It's exactly that is the canary in the coal mine when it comes to financial crisis. Look at the private debt, because at some point private debt will be so high that you can reasonably expect that a lot of people won't be able to pay it back in case of a minor external event, right? And then if that happens, there's massive information asymmetries, and the lenders won't be able to figure out who is creditworthy and who isn't creditworthy. So private debt is really like the thing to look out for. Is public debt important? Is it more important than private debt or not? I mean, because of my particular, I will admit, ideological leanings, I do think that private debt intuitively is much more important. But I wouldn't die on that hill given my own expertise. Like I can't say that's a definitive answer. I do think, however, again, so Minsky is a Keynesian, so Keynesians are not particularly worried about public debt because it's a really useful instrument for dealing with crises, right? So expanding public debt can, in some cases, be actually really, really helpful in order to overcome a crisis quicker than you otherwise would. So how worried would I be about public debt? Again, given my slightly Keynesian leanings, not as much as private debt. But if you're asking me if how certain I am in that answer, I would defer to an economist. I'm still a philosopher at heart.
Yeah. I mean, that's a good piece of news for us Italians, because we have a high public debt and a low a high public debt and a low private debt. And so, but the fact that we have a very low private debt is often neglected. And so why discussing
Yeah.
how healthy is the Italian economy.
Yeah.
So
I
thank
mean,
you
I
for your
mean, I mean, it's always worth looking at private debt levels in the US and all over the world. I mean, what private debt essentially tells you is that something with your domestic economy isn't really working, especially if household debt increases. It either means that real estate prices are probably too high. It's really risky for people to take on really large mortgages, which they're forced to take on because prices just don't come down. Or it means that people are taking out loans in order to finance consumption because their wages are too low. That's something that I see happening with a good number of family members of my partners in Turkey. So you can see like those people simply survive on taking on more and more and more credit right now because wages are simply too low to actually like keep their expenses at a stable level. So yeah, inflation is the other part of this equation, but I won't talk too much about this right now. But yeah, I think like high private debt levels usually that there's something off about your economy. There's something not particularly well balanced here. At least that I think we should be fairly sure of.
Thank you very much.
Yeah.
I don't know if there are other questions coming from the audience. Otherwise, we can stop here. So there is Lisa. Yes, Lisa. Okay.
Yeah. This is maybe, I know it's not the main focus of your paper, but I'm wondering if you could say a little more about the ex ante, ex post difference. It sounded like you were trying to avoid dealing with probabilities, in the ex post version, and I don't think we can do that. It's going to be, it's decision making under uncertainty, and I think we're going to be weighing the risks against each other, and we're going to have to consider the, probability that certain events would occur as we're trying to make an assessment as to the, moral worthiness of an action. So I'm thinking of cases like say in a vaccine, there are going to be some number of bad side effects. There might be neurological side effects, so on and so forth, and they'll be rare. They'll be maybe 1 in a million, as you had in your example. But we have to not only think about how to mitigate those, but also think about the probability that they will occur. So I was just a little unclear as in terms of how you were framing the difference between the two versions of contractualism and what you saw the strengths and weaknesses of each.
Yeah. Thank you. No, that's actually I probably should have been a little bit clearer about that. So you might think that ex post contractualists aren't really interested in probabilities, as you've kind of said, right? Like the second we determine there's one person who is almost certain to die, that's the kind of threshold that we worry about all of a sudden. But insofar as probabilities express frequencies in a particular population, right? What the exposed account essentially tells us is that look at how many people will die, rather than or are above this kind of threshold of being extremely likely to die or extremely or almost certain to die, right? So probabilities do matter, but they do matter as an expression of frequency in the exposed account. Because for the exposed contractualist, there are different views on how to aggregate numbers and how to aggregate burdens in contractualism, but like the simplest version of this will be some kind of a tiebreaker argument. So in order to assess, for example, whether you should give out a vaccine or not, right? What you would have to do under the exposed approach would be you would have to assess how many people will die without the vaccine and how many people will die with the vaccine. That's essentially the idea. Pick the smaller number then. So probabilities will matter in this particular way as running the tiebreaker here. So that's
what about a case where the outcome is not death, but something less severe? So it's a bad outcome, but it's not death, and then you're weighing that bad outcome against, other actions. Because that you're picking a very extreme case. It's, either the person lives or they die, and then there's going to be a frequentist distribution, in the population. But if it's something less severe, it's a negative outcome, but you have to weigh it against other costs and benefits. How's that handled on the ex post view?
So I've already said that contractualism is, at least in my view, a somewhat incomplete view. And in particular, one of the problems that contractualists face is this idea of comparable burdens, right? So I think that's kind of the solution to this puzzle here. So let's say there are 50,000 people we expect to die in a population of 10 million or something like that if we do not give the vaccine. And there are, let's say, 100,000 people who will, for some freakish reason, lose their arm if they get the vaccine, right? Saves their life, but they lose the arm. So then what the exposed contractualists do would be he would compare the loss of an arm to the loss to death. So in some cases, we can settle the case already here, because if it turns out that, losing an arm is not a harm that is, or a burden that is comparable to losing a life, then you should administer the vaccine. If it turns out that these two burdens are comparable, then we need to engage in this tiebreaker thinking again. But whether this is the case or not in any particular case, well, it's been some time since I've been knee-deep in the contractualist literature. Maybe something has moved on this comparable
Yeah.
harms burden, but as far as I know, there's still kind of a bit of a gap in the literature with regard to this. Yeah.
Okay,
So I hope
thank
that
you.
was helpful. Yeah.
Yeah, no, that is. Thank you.
Cool.
Okay, so I don't know if there are other questions. I don't see questions, so we can stop here and thank again very much Richard and Kobe. Thank you very much for
Thank you,
this
Kobe.
interview.
Thank you, Lisa. Thank you, Emiliano.
Okay.
And I hope to
Thank
see
you.
you soon on the next event on finance. So
Very much so.
bye.
All right. Bye,
Okay,
everyone.
right.
Enjoy your evening.
Bye.